Okay, buckle up, everyone. Today, we are strapping in for, well, maybe some financial turbulence.
Oh, possibly.
We're diving deep into the U.S. airline sector. We'll be analyzing three titans, that's American Airlines, Southwest, and Delta, using a really detailed expert stock screener report.
That's right. Think of it as a custom high-altitude flyover.
Yeah, exactly. We're looking at the fundamental data, the potential trends, recent news flow, the whole picture.
Right. Our mission here is to synthesize all that data. The basic snapshots, financial health, valuation metrics, technical signals, news updates for AAL, LUV, and DAL.
So you get a comprehensive, sort of multifaceted look at these industry leaders.
Exactly. We want to give you the different angles on what's driving these companies.
And these three, I mean, they represent really different stories, don't they? You've got American AAL, the smallest market cap of the three, but it often sees, well, a ton of trading activity.
Yeah, very active.
Then Southwest, LUV, the classic low-cost leader,
Mm.
known for, its operational stability, historically at least. And finally, Delta, DAL, that's the giant. Largest market cap, premium brand recognition.
Right. Now, before we really get into the weeds here, just one crucial reminder. This discussion, it's a journalistic report. We're analyzing publicly available data, and it's purely for informational and educational purposes.
Okay.
It should absolutely not be taken as investment advice. We're just exploring what the data seems to be telling us.
Got it. Important distinction. All right, let's kick off with American Airlines Group, AAL, the leveraged recovery play, as some might call it.
That's one way to put it.
So last close was $11.58. Market cap, relatively small for this group, $7.64 billion. But what just screams out from this data is the volume, average volume, 75.51 million shares a day. That's huge.
It is. That volume immediately tells you AAL is, well, highly watched, maybe even a bit speculative. And when you dig into the valuation, you start to see why.
Okay.
The current PE is around 14.89, which, seems reasonable on the surface. But look at the forward PE. It drops massively to 6.98.
Wow. Okay, so the market's pricing in a huge recovery.
A phenomenal recovery. I mean, the data projects EPS next year growing by an absolutely massive 282.96%.
Wait, 282%?
Yeah.
Seriously, that seems almost absurdly high. Is there anything in the news justifying that, or is this just pure market hope?
Well, it's really driven by the contrast in their numbers. Look at their price-to-sales ratio, the PS. It's incredibly low, just 0.14.
Okay, meaning
Meaning their huge revenue base, we're talking $54.25 billion in sales, is generating very little market value per dollar of that revenue. They move a lot of people, but margins are thin.
right, high volume, low margin.
Exactly. But here's the big one. The critical fact, the sort of financial red flag that defines AAL right now, its book value per share is negative. It's sitting at minus $5.87.
Negative book value. Okay, break that down for us. What does that mean in simple terms?
Sure. Think of book value like your net worth if you sold everything you own and paid off all your debts. For a company, it's assets minus liabilities.
Right.
So a negative book value means AAL's total liabilities currently outweigh its total assets. They're essentially operating on negative equity.
Wow.
They're relying entirely on borrowed money and, crucially, that future profitability to fill the hole.
So AAL is basically a highly leveraged bet on recovery, priced for astronomical growth, but sitting on a mountain of debt structurally. How's their, day-to-day cash situation?
Predictably tight. Profitability is razor thin, profit margin only 1.05%. And liquidity, well, the current ratio is 0.58, quick ratio 0.48, both below that important 1.0 mark.
Not great.
No. And reinforcing that leverage point, their debt to equity and long-term debt to equity are also negative because the equity itself is negative. They have to hit those future earnings growth numbers. There's not much cushion.
Okay, let's shift gears slightly. What about the technical picture, the chart? RSI is 38.75, so
Yeah.
kind of near oversold, but not quite there.
Yeah, it's consolidating near the lower end. Technically, the stock's been struggling. It's trading well below its 20-day, 50-day, and 200-day moving averages. That long-term SMA 200 is actually about 10% above the current price. So for a technical buy trigger, you'd really need to see AAL decisively break above the 50-day average. That's around, $12.30 right now?
About that, yeah.
A break above that could signal a shift in short-term sentiment, the sell trigger. Well, that would be a sustained drop back towards that 52-week low of $8.50.
And performance-wise, it's been rough year to date, down over 33%. But it did have a strong bounce over the last half year, up almost 22%.
Correct. A very volatile ride.
Which fits the news flow, right? We saw recent downgrades from analysts, Raymond James, Goldman Sachs, citing those valuation concerns. But then Zacks comes out in early October saying AAL exceeds market returns. Mixed signals.
Very mixed. It highlights the debate around that recovery potential. Now let's do that paper money math just to illustrate the rebound potential, or what happened already.
Okay, fun part.
Right. So imagine a theoretical $5,000 investment made right at AAL's 52-week low, which was $8.50. That $5,000 would get you roughly 588 shares. If you then sold those shares at the recent close of $11.58.
Let me guess. Decent profit.
Yeah, you'd have a paper profit of about $1,812.64. That's a 36% gain from that low point.
Not bad at all. Shows the power of catching that bottom, even with the underlying stress.
Exactly. A powerful run from the floor, but the fundamental questions remain.
Okay, let's pivot now from AAL's high-wire act to Southwest LUV, the historically steady operator, the institutional anchor.
Right. LUV has a market cap of $17.08 billion, closed recently at 32.52 cents. And the most defining feature here, I think, is that institutional ownership. It's staggering, 95.27%.
Pretty much. It tells you Wall Street sees LUV as a core holding. Like, everyone in the club has this one. Valuation-wise, the current PE looks high at 48.90.
Yeah, seems steep.
But again, look at the forward PE. It drops significantly down to 13.60. And what's really interesting here is the PEG ratio. It's favorable, sitting at 0.96. Okay, let's make sure everyone catches the significance of that PEG ratio. Remind us.
Absolutely. So the PEG ratio compares the stock's PE multiple against its expected earnings growth rate. A PEG below 1.0, like LEV's 0.96, generally suggests the stock is reasonably priced relative to its future growth expectations.
Gotcha.
And those expectations are high EPS growth projected at 51.11% over the next 5 years. So unlike AAL, which seems priced purely on recovery hope, LUV offers potential value based on projected growth.
And LUV pays a dividend too, right? 2.18% yield, though the payout ratio is quite high at 95%.
It is high, meaning they're paying out almost all their current earnings as dividends. Now, how do their books look compared to AAL's stressed balance sheet?
Yeah, good question.
Well, LEV's in much better shape financially. Liquidity metrics, the current ratio, 0.56, and quick ratio, 0.49, are still tight, which is pretty standard for airlines, but they manage debt responsibly. Their balance sheet is much stronger. Positive equity, manageable debt-to-equity ratio of 0.67. So if AAL is relying purely on future growth hopes, LUV has a far stronger foundation today.
Well, the trade-off.
The trade-off is their low-cost structure often means thinner margins compared to legacy carriers. Their profit margin is 1.45%.
Technically, though, the picture looks pretty robust. RSI is neutral, 52.83.
Yes, technically LUV shows decent short to medium term upward momentum. It's currently trading above its 20-day, 50-day, and 200-day moving averages. That generally confirms a positive trend. The stock's up almost 9% over the last year. So a technical buy trigger here would be seeing the price stay consistently above that SMA 200, which is around $31.62. That would reinforce the existing bullish trend.
And a sell trigger.
A sell trigger could be a sustained break back below the SMA 50, suggesting that shorter-term momentum is fading.
Okay, so technically solid, institutionally loved, but recent news highlights a challenge, right? Despite good things like network expansion in Alaska, Sonoma County, and free Wi-Fi partnerships.
Yeah, that T-Mobile deal.
Right, but they hit a major speed bump in July. Their Q2 earnings report was called dismal by some analysts, causing an 11% stock drop, weak outlook. So institutional confidence is high, but recent performance, disappointing.
That's the tension right now with LUV. The market loves the story, the history, the ownership, but the latest results raised eyebrows. Let's quantify LUV's rebound with the paper money again.
All right.
Same deal. Theoretical $5,000 investment, this time at LUV's 52-week low of $23.82.
Okay.
That gets you about 210 shares. Selling those at the last close price of $32.52 gives you a paper profit of $1,829.20.
Huh. Interestingly, almost identical profit in dollar terms to the AAL simulation.
Virtually identical, but, and this is key, LUV's underlying financial position, that equity base, is far, far safer than AAL's. Different risk profile for a similar rebound gain from the low.
Makes sense. Okay, finally, let's turn to the heavyweight champion Delta Airlines, DAL. Largest market cap, $37.39 billion, closed at 57.26 cents. Given AAL's leverage and LUV's stability meets doubt situation, what defines Delta?
Quality. Plain and simple. Based on this screener data, DAL emerges as the clear quality leader. Its valuation metrics look the most attractive right now.
How so?
Low PE of 8.31, even lower forward PE of 8.18, and crucially, its PEG ratio is also excellent at 0.91, again, under 1.0, suggesting it's potentially undervalued relative to its expected growth, which is pegged at about 9% over the next 5 years.
Okay.
And Wall Street seems to agree. The analyst recommendation averages a very strong 1.40, closer to a strong buy with a high target price estimate way up at $70.46.
So good valuation, strong analyst backing. Where does that quality really shine through in the numbers?
It's the profitability metrics. DAL boasts a solid 7.24% profit margin, which is good for an airline. But the real standouts are the return figures. Return on equity, ROE, is an outstanding 30.07%.
Wow, 30% ROE. That's huge for any industry, let alone airlines. Put that in context for us.
Absolutely. ROE measures how much profit a company generates for every dollar of shareholder equity invested. So a 30% ROE means Delta is exceptionally effective at turning shareholder money into actual profit.
Okay.
It speaks volumes about their management effectiveness and how efficiently they're using their capital. It makes DAL a true quality leader here, far outpacing AAL and LUV in current operational performance. Return on invested capital, ROIC, is also strong at 12.54%.
That's impressive. Interestingly, though, even with that strong performance, the screener shows their liquidity is actually the tightest of the three. Current ratio at 0.38.
Yeah, that is the potential trade-off. Their short-term cash position looks the most constrained based on these ratios, but their debt seems managed with a debt-to-equity ratio of 1.22. They're running lean, perhaps, but generating substantial profit while doing it. You saw that in their strong recent quarterly EPS growth of over 62%.
Right. Okay, technically, RSI is neutral, 44.99. But the longer-term trend has been pretty spectacular, hasn't it?
It really has. While the stock has seen some mixed short-term signals lately, maybe some consolidation, it's strongly supported by its 200-day moving average, trading over 5% above it right now, and performance, up nearly 48% over the last half year, almost 15% over the last full year. And get this, it's soared almost 65% above its 52-week low.
65%. That's a massive run.
Huge run. So the technical buy trigger here is really about sustained consolidation above that key SMA 200 level, confirming that powerful long-term uptrend is intact. A sell trigger would be a confirmed break below that 200-day average, which would be a significant warning sign for the long-term trend.
Got it. Delta's news flow seems focused on execution, right?
Yeah.
Maintaining their profit outlook despite industry headwinds, strategic partnerships like the one for cargo handling, and they got a buy upgrade from Jefferies recently.
Yep.
The only negative headline was that odd incident of two of their jets colliding while taxiing at LaGuardia. A reminder of operational risks, I suppose.
Always a factor in this industry. Okay, final paper money simulation. Let's see how DAL's run looks. Theoretical $5,000 invested at DAL's 52-week low of $34.74.
Okay, lower entry point than the others.
Right, that would get you approximately 143 shares. Selling those at the last close price of $57.26.
This should be good.
It is. The paper profit comes out to a substantial $3,188.98.
Wow. Over $3,000 profit on a $5,000 theoretical investment.
Exactly. A much bigger gain than AAL or LUV saw from their lows in the simulation.
Okay, let's try and synthesize all this. Unpack this high-flying comparison. We've seen three really distinct profiles emerge.
Absolutely.
AAL seems like the definition of a high-risk, high-reward play. Cheap on sales, yes, but structurally weak due to that massive leverage. It absolutely needs that huge future growth just to get back on solid ground.
Correct. It's priced for perfection, essentially, on the recovery front. Then you have LUV. It's the reliable name, the one institutions overwhelmingly own.
The anchor.
Yeah, the anchor. But its value now seems heavily predicated on delivering that strong future growth, especially after that disappointing earnings miss put some doubt in the air.
Right. And then there's DAL.
And DAL stands out as the financial quality leader based on these metrics. Superior profitability, that incredible 30% ROE, really tells a story and an attractive fundamental valuation with that sub 1.0 PEG ratio.
So connecting it all, AAL's valuation hangs entirely on hope for that 282% growth next year, actually materializing. DAL is the quality stock generating strong profits today. And LUV is sort of the stable, institutionally backed middle ground, but facing some skepticism about hitting its future growth targets.
Well put.
And that paper money exercise really hammered home Delta's success story over the past year, didn't it? generating over $3,100 in paper profit on that $5 K investment from the low. That significantly outpaces the roughly $1,800 gains we saw simulated for AAL and LUV.
It certainly highlights the magnitude of DAL's rebound in performance from its floor compared to the others over that period. It delivered the biggest return from the bottom.
So this brings up a really interesting question for you, the listener, to ponder. When you're looking at a volatile sector like airlines, what's a better signal for potential sustained strength? Is it following the institutional money, LUV's 95% ownership suggesting Wall Street conviction? Or is it betting on the company with the proven financial health and superior current performance, like DAL's 7.24% profit margin and that standout 30% ROE? Institutional belief versus current financial reality. Which matters more?
That's the key question, isn't it? There's no single right answer. It depends on your own view and risk tolerance.
We've laid out the data points for you. Valuation, technicals, news, financials. Now it's your turn to connect those dots. Thanks for taking this deep dive with us today.